Hello, everyone. Welcome to today's YouTube session. So in today's session, we'll have a quick look on the 5 common misconceptions that could cost you thousands of dollars on your tax savings. Okay, let's have a look. So before going to the main content of the session, just a quick declaration. The information provided today is for information only. Before you make any decisions, please make sure you talk to a registered tax agent, financial planner, or solicitor in their related field. Okay. Um. All right. Common misconception number one. Um. You can only claim car expenses if it was registered under your name. That's actually not the case. So you can actually, if you're curious, do a Google research. Okay, tax office actually allow you to claim car expenses even if the car is registered under a family member's name or even a friend's name, provided that you have paid on the expenses or reimbursed them on the expenses. Okay. So of course, in a common family scenario, it's quite often that you would reimburse each other's expenses in different ways, right? Because one family member could be paying some expenses and family member would be paying the others. And indirectly, you have reimbursed each other. All right, so that's the common misconception number one. Misconception number two, you can only claim expenses if the invoice and transactions were under your name. So you might know that you could use bank statement or credit card transactions to claim expense deductions. Okay, if you're ticking all the boxes, if you're meeting ATO eligibility requirements. Um, so in a similar token to the first misconception, okay, if family members spend on each other, let's say if one family member bought a laptop, that's actually for another family member to be used for business related purposes. Okay, that can potentially still be deductible. Okay, even if it was paid by someone else. Okay, if you have indirectly um, reimbursed the person who paid the expenses. Okay. All right. Third misconception, you should purchase more work-related items to reduce your tax. This one is actually sometimes it gets a little bit frustrating because every single year when we receive new clients, sometimes they have other tax agents. I'm not saying that this is from all tax agents. Most tax agents are trying their best. They're well educated, have the right experience to be able to provide the right advice. But sometimes it does happen every year. Sometimes we notice new clients coming to us saying, okay, last year my tax agent told me to go out and buy more work related items just to incur more expenses simply to add more to the tax deduction. This is actually a wrong way of thinking because when you are spending on expenses, your net saving is only the tax exclusive amount. Okay, once you remove the tax, the majority of the expense is still from your own pocket. Okay, so be very careful. Even for people who are paying 47% on tax, the tax saving is only on that 47%. You still need to pay 53% from your own pocket. So make sure you don't just go out buy items for the pure purpose of tax saving, only if you do need to purchase some work related items. All right. Okay, misconception number four, all meal expenses are entertainment for businesses, and they're not deductible. That's actually not true as well. For our business clients, they already know, yeah, tax office actually, especially in the FBT section for office meals and refreshments, that's provided to employees. Okay, it's actually deductible for the business or for the employer. Okay, so this is the common misconception. Again, every year when we receive new business clients, sometimes it happens that they just didn't know about this one. Yeah, so they're actually missing a lot of legit deductions for themselves. Yeah, when they're business owners, as directors, they can be treated as employees too. Yeah, plus all their employees. When they incur eligible office meals and refreshments, they are actually deductible for the business and for the employer. All right. Okay, misconception number 5. I only need to consider retirement planning when I'm close to retirement age. Okay, this is actually probably one of the biggest opportunity for someone who's in their 50s that's missing, okay, for their retirement planning. Because when um, you're reaching 60 years old, you can actually start a transition to retirement pension. And then you can start withdrawing money tax-free. And on the other side, you can start contributing, if you're still working, okay, when you're 60, you can actually keep contributing to your super fund, 30K. That's the current concessional super contribution cap. Okay. And then on the contribution, concessional super contribution, you can still claim a tax deduction. So on one side, you can potentially get a tax-free income from your super fund, and then you can also top it up through concessional super contribution and claim a tax deduction from your employment income. Okay, there are many other common strategies. We did have other YouTube sessions that's covering this topic. So you can actually watch some of our other sessions as well. All right, so that's everything for today. Here is a quick introduction of myself. Okay, you can pause the video to have a look, and that's everything. Yeah, so also if you want to check with us, if you have any questions, our contact details are here. Just send us an email, give us a call, contact us anytime. Thank you. Bye-bye.